So the Bank of Japan intervened in the FX market yesterday. We're going to have a look at that. And the Bank of England have this morning said that inflation is mainly down to wage growth. And then the trading takeout today is going to be examining hysteria and seeing if there's trading opportunity there. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So, yes, the Bank of Japan intervened in the FX market today for the first time in about a year now. You can see the drop off here. So we've clearly got a level at 150, which they are aiming to defend. Now, I know this market and I know people are very, very cheeky in this market. And what they're going to do is they're probably going to test the resolve of the Bank of Japan again. There's also no reason for it not to be tested because the conditions are still the US yields are increasing and the Bank of Japan is keeping easy monetary policy. So their yield curve is pinned in the 5 to 10 year range. It's pinned at a certain basis point level. So all you're looking at is the deviation or the difference between Japanese yields there and US yields. And so my view is that the reason they did intervene is that they really had to watch the FX market in terms of, okay, we are reaching 150 now. Let's test the market, see if it accepts it. It kind of hasn't really accepted it. You know, we had a fairly large drop off almost of 300 points, but the market bounced back up straight away. And I think this big bounce is really showing you what the market thinks. It's thinking, hang on a minute, we're testing this unconventional policy that they're doing here in terms of them buying the yen. Let's see how far they really want to take it, especially in these conditions where nothing's really changed yet. So it's a very, very interesting time around this 150 level. And I'm wondering if they're going to actually think of revising it even higher. The actual top is, let me just get the actual top up. So the actual toppy level is actually 152-ish. That's where they intervened before last September or October even. And that intervention was the first time since 1999, I believe, that they intervened. So I think if we do start reaching up to these levels, that's where we might see, you know, a bit of a broader reversion. But also what that may mean is equities start getting a bid again. Time will tell. But I think this initial intervention is limited in scope, and I do think that it's a bullish opportunity, perhaps, if you can get the right execution parameters there. So interestingly, Bailey's come out and spoken to Prospect magazine in the UK, which I think is left-leaning. I'll have to double-check that, but I'm pretty sure they're a left-leaning magazine. And he said that the UK labour market explains part of UK inflation. That he sees more shocks coming and geopolitical instability has consequences, which is interesting considering, you know, what I had mentioned with regards to the Turkish lira just yesterday. But if we flip over and have a look at cable then, it's in kind of an interesting place, cable. It's very similar to the euro and it's all explained by the dollar here. And everything at the moment is pretty much a dollar trade. We're seeing, you know, the market get bid up here right after those comments have come out because they're quite hawkish. You know, they are a very, very hawkish set of comments with regards to, okay, he sees more shocks coming. That could be interpreted as, you know, dovish shocks, you know, but most likely it's going to be inflationary shocks considering the context of talking about wage growth increasing. The shocks that I think he's actually referring to come from the energy sector here. The UK is not as susceptible to energy price shocks as other places now, but I still think that there is considerable damage that can be done over this winter, especially with the nat gas market, oil creeping up, etc., etc. I've already seen petrol prices go up. I put about 60 or 70 quid a week into my car. It is a Range Rover petrol though, so that is a real issue, and I think I might sell it. But beyond that, I actually like the look of the pound off of these comments. We're right down into this low range. You've seen the range low get taken. Zoom out a little bit more. There's probably some more debris down this way. Prior range low here as well. So we're into a bit of support, and on an intraday basis, you could be looking for a movement up to seeing if we can test this range high. Test this support level and run this range high. So you'd probably be looking at a bit of a pin bar up into here and then trade back down into the range. That is potentially the structure that we would be lovely to see here, actually, off of these comments, especially if we can get in before the new US news later, which, by the way, is mortgage applications, ADP, national employment data, and the global composite final PMIs, global services PMIs, US factory orders, ISM non-manufacturing, and we got all the oil data at 3:30 UK time. So there's a lot of stuff coming out today, right after the US Open. And there are definitely things to pay attention to, especially the US factory orders. I think the expectation is 0.2%. If we do get a beat on that, that's going to be quite hawkish in my view. I think everyone's looking at manufacturing now in terms of, okay, what potential knock-on could this have on US employment? And that's the real economy in the US. That's the real sort of meat and bones that we have to look at for indicators as to whether the US economy is going down the toilet or not. And I've mentioned a few times that employment is the key here. I think if employment starts going, that's when we really, really start to see the US economy face those recessionary shocks that, the inverted yield curve is showing and things like this. So, definitely pay attention to the US data later today as well. But, from the Bank of England's perspective, they're very, very hawkish comments. And when you're looking at that cable, it's important to pay attention to what's going on in the US, naturally, not just the UK, because the dollar is so dominant at the end of the day. It's probably more important to pay attention to what's going on in the US than the UK, to be quite honest with you. But yeah, that's it. I think, bottom line is that Bailey's hawkish. He expects some shocks. Whether they'll come true or not, we don't know, because I don't think he's a very good governor. But those are the comments. The market's reacted, taking the low, and it looks bullish. Today's trading takeout is how to use market hysteria to your advantage. Now, we spoke about the Bank of Japan and their FX intervention previously. And I think it's a great example of, how to use the current context of, okay, they've dropped the markets by 300 ticks. Who is going to get stuck thinking that it's going to continue, and who can actually think a little bit more level-headed and examine the situation for what it is. Now, before they did this, the whole trade was that US yields are increasing and Japanese yields were flat, basically. So that's going to lead to the dollar increase in the yen getting sold off. It's been like that for 20 years now. And as a result of this, you've got to examine after this initial shock, okay, what has actually changed here? Has the context of US yields increasing changed? No. Are people still thinking that the Bank of Japan are going to keep easy monetary policy? Yes. So all that is coming together here is a probabilistic bet that these things are going to keep going on. These factors that have driven the market, in terms of dollar yen up and up and up over the last however long years, is going to continue. And just because there's a shock doesn't mean that shock is going to carry on over the midterm. It is a short-term price shock. So if you can find areas to do business at, which are advantageous to make use of this shock over the midterm, over the length of time that many people might be looking at things, in the short term, then you've got a much higher probability of having a successful idea come out of it. I don't always like to use the term trade. I like to use the term idea, because you can go in and out of trades. It's ideas that remain a little bit more constant. So find areas to do business at when an initial short-term shock comes, and you can kind of manipulate it to your advantage over the midterm.